So today we'll go a bit further. We'll look at changes in group structures. Look at where we are actually coming from. Let me just first stop sharing. So look at where we are coming from. First, we looked at the scenarios where we actually said uh, the parent company or this company, company A, buys more than 50% shares in company B. Company A automatically assumes the responsibility of consolidating for the group, and that company A becomes a parent company. Whereas that company that has sold more than 50% shares to now the parent company is called the subsidiary. So we looked at that, we came up with goodwill and all those other things, tried to consolidate it, and we are just calling it as basic consolidation. Yeah, yeah, following the rules set by the International Accounting Standards Board, that is IFRS 10 and also IS 27. Also 27, which is just on group accounts, and the IS 28, which is on associates. Then we said, wait a minute, in real life, it doesn't just work like that. There could be other complications or other scenarios that would actually come into play. One of the scenarios that we brought in was there is nothing that stops company B, which is a subsidiary, to also buy shares in company C and maybe buy more than 50% shares in company C. Whereas company A has no direct relationship in company C. So we said if such a scenario happens, how do we actually treat the transactions? And that's where we came up with what we called complex group structure. And we looked at that as a V-shaped structure, which is basically the vertical one, meaning you have A, you have B, and you have C. No relationship between A and C, no direct relationship. But because he's a parent to this company that has actually acquired the majority shares, you eventually becomes a grandson or a granddaughter, and you will be called a sub-subsidiary. So we looked at the scenarios, we looked at the, the differences that would come in. Like, for example, on the goodwill computations, we said for the sub-subsidiary, the fair value consideration, we should multiply it by the percentage holding of the parent company in the subsidiary. That is what we looked at. Then we went again to the NCI. We looked at the computations there. We also looked at the investment that the subsidiary has in the sub-subsidiary, and we computed the NCI percentage, which would be subtracted from the post-acquired and the acquisition NCI. I guess you should remember that. Because it said if we don't do
Yes.
that, then we're going to actually do a double counting. There'll be a double counting. Then the rest was just the same with the basic consolidation on the group retained earnings. That was basically the same. So the major differences which were coming in, it was just on the NCI and the goodwill
Okay.
computation. And on goodwill
Goodwill.
computation, it was just on the fair value consideration. Then we said this is a possible scenario that would happen in a real life. So in a real situation, we expect such a scenario to actually pop up. But we said, else would come in? So we found another scenario. This scenario, we were saying, what if the parent company also has shares in the subsidiary, direct shares? What happens? Then we went on to also discuss, Yvonne, that you see, sometimes the, the parent company can enter into unwritten agreement with the subsidiary to buy shares in another company. But the way they would buy shares, they would not want to show that this particular company has, or a single company between those two has the majority shares in the subsidiary. So they would increase their shareholding control by having the subsidiary buying shares less than 50%, the parent company also buying in the subsidiary less than 50%. But when they add those two numbers, it gives them more than 50% shares, meaning that at that time they have control. So they could do
Mm.
such strategies. But then after looking at all those, the D-shaped, and how to compute and the differences that come therein, we say this is what we'll be looking at today. We say there could be group changes. It's either the parent company bought, say, more than 50% or 75% of shares in the subsidiary. Then the parent company decides to shed off maybe 10% or 20% of the available equity interest in that particular company, which is the subsidiary. Meaning that then we are actually looking at disposal. But there could also be another scenario where the parent company decides to acquire more shares. If, say, it had 60% equity shareholding, it increases to 60 to 72. So if it increases 72, what happens with the non-controlling interest? Meaning that the non-controlling interest reduces. You get that? But at disposal, if the parent company is disposing, we expect the NCI to be credited because
Yes, sir.
the NCI increases. If your parent company, sorry, if your shareholdings is reducing, it is actually reducing, what happens with your NCI? If you are moving from 70 to 60, meaning that your NCI increases by the same margin that you are actually shedding off your equity interest. Okay? You are confused. Let me draw something. What we are saying that you have a parent company which has, say, 75% interest. sorry, I'm mute. Sorry. So I'm saying you have 20% parent company and 5%, the NCI 25%. So if say the parent company decides to shed off or maybe do acquisition, decides to acquire 5%, it will have 80%, whereas whereas the NCI will be debited. You need to understand that will be debited, and that debit will actually cause this to reduce, will be debited by 5, it will have 20%. So if the parent company, it was actually going to 70%, it means that the NCI will have 30%, meaning you're actually crediting the NCI account. So what we'll be looking at under the changes of group structure will be on the issues of acquisitions and the disposals. So we are saying those will be some of the scenarios that we'll have to actually take into consideration. So let's go there and see what it is.
Okay.
So changes in group structures. First is about business combinations achieved in stages. Here, under business combinations, it will actually be guided by IFRS 3, which is literally on goodwill computations. Then we'll then now go to another scenario, which we have already explained the other scenarios on acquisitions and disposals, where control is retained. So this is just my observations and the exam expectations, which you should definitely take into consideration seriously. So I'm saying the CA Zambia syllabus ranks group accounts highly, and it is most likely that complex consolidation questions will be dominant in the future exams, and we have seen it. I think there is no exam, unless I don't know, you have to correct me, which does not have group accounts. So you expect questions on group accounts. So there's a methodical and structured way of tackling group accounts questions, which obviously people call me Coach Carter in case you don't know. It's just that you're alone, so you have been calling me Sir. But people know me, they say Coach Carter, or even the people that referred you to me, they'll say Coach. So which Coach Carter did demonstrate to you, which I've already shown you the 5-step stage on the group accounts, and you need not just memorize it, but to understand the logical flow from structure, group structure to assets, and you move on. Let it be part of your. So the examiner likes to test business combinations achieved in stages, sometimes called step or piecemeal acquisitions. So the examiner likes that. So there could be scenarios here. Another scenario where this company had 0 shares in company B. Nothing as in nothing. Then starts acquiring in piecemeals. Maybe acquires about 40% of the shares, maybe becomes an associate. And over time keeps on until has the majority shares in that company and becomes a parent company. So what we look at? So as it decides to acquire shares in piecemeal over time, that company can lead into an investment in equity instruments, and if it remains on the same acquisition trajectory, it can even become an associate and then a subsidiary. So we're saying, remember what makes if you are looking at an investment or in equity instruments, is where a company acquires less than 20% shares.
Okay.
As a rule, of thumb. Acquiring between 20 to 50%, it means that you're an associate. So look at this company, look at the company, look at this company, visualize that it is your company, Vaughn, where you start with nothing, you as a company, you haven't acquired anything, no company has been acquired by you. You go to this other company, you buy 10%, and you just become an investment using equity instruments or whatever treated under that, which could be under IFRS 9. Then from 10%, you then buy shares that take you to more than 20%, but below 50. Then you become an associate. With all your dreams,
Okay.
with all your dreams of wanting to become a majority shareholder in that company, burning, still alive. Over time again, you buy more shares, you move from 20 to 52. You now become the parent company. So we want to track that piecemeal scenario and see how can we treat this. So I'm saying, and if it remains on the same acquisition trajectory, it can even become an associate and then a subsidiary. So you are advisable to comprehend the concepts and completely deal with each of these situations. Note, you may sometimes see the term trade investment or just financial asset instead of investment in equity instruments. It is the same thing.
Why is she crying?
My
Go
internet,
and bring her papa.
I'm sure you've observed that my internet is extremely bad today.
Internet is bad today. Yeah.
It keeps on dropping.
It's dropping.
So one thing that you need to note is that investment is not an associate or a subsidiary. It is accounted for under IFRS 9. As long as you've bought more than, no, as long as you've bought less than 12% of equity interest in a company, you're actually not going to be an associate. So let's look at these three types of business combinations, which is actually achieved in, in stages. I'd already given an example. We're saying you are starting from zero and maybe you previously held, say, 12% with no significant influence. So without significant influence, meaning that you'll be accounted for under IFRS 9, like I said. IFRS 9, it is actually a standard that focuses more on financial instruments. Then you is increased to a controlling interest of 50% or more. So this is the first type of business combinations where you're starting from equity investment and you keep on going.
Sharing something. Hello?
Hello?
Have you shared something?
Yes, I have.
There's nothing. There's nothing.
Oh, let me do this. Are you able to see it?
No, it is just saying you have shared the screen, but the screen is blank. Okay.
It's a problem
Okay.
with your internet as well. It's your internet, trust me.
I think so. Okay, that I've seen them.
Okay. So we are saying that the first scenario is a situation where you have, say, less than 20% of equity interest, which then you just become an equity, it's an equity investment. You have no significant influence, not even control, and you'll be accounted for under IFRS 9. Then over time, you keep on increasing until you go to more than 50% or more. That's the first scenario. The second scenario, it is where you are an associate and you start increasing your equity shareholdings until you go to beyond 50%. Then you have a third plausible scenario where you are, say, 60 or 70, you go to 80, you go to 90. Yvonne, is it okay on these three possible scenarios that would happen? And we should know how to treat all of them.
Yeah, I'm getting you.
Okay.
The previous
So the first two transactions are treated in the same way, but the third one is not. There's a reason why the first two are treated in this similar way. Because in the first two scenarios, until you go and get more than 50%, that is when you're actually going to have to compute goodwill.
I'm not getting you what you're saying.
I'm saying it's not things today.
Yeah, today it's
Okay, let's endure. Let's finish this part. So what we are saying is that, remember we looked at three scenarios.
Mm-hmm.
We looked at three scenarios. The first scenario, it is where first let me stop sharing so that I explain this thing nicely. We looked at three scenarios. The first scenario, it is where as a company you have less than 20% interest or equity interest in company B. And we said that you'll be treated under IFRS 9 because it's just a financial asset. Then you start now increasing step by step until you acquire more than 50% equity interest. Scenario two, this internet. Scenario two, it is where you have more than 20% interest, you're an associate, and you start climbing the ladder until you have more than 50% equity interest. Then obviously you become a parent company. Scenario three, it is where you already have more than 50% interest.
Go out if you want.
Hello, are you able to hear me?
Yeah, I'm getting
you. Scenario three, it is where you have more than 50% interest and you're increasing maybe from 60 to 80. Then we said, these two, they are treated in a similar way. The other one is not treated like the way we treat the first two that have been explained, the first two scenarios. And we said there's a reason to that. And it's very easy. For the third one, you don't say any changes you make, you start calculating goodwill. You don't do that. Goodwill is goodwill. Remember that goodwill is a combination of the NCI and your inputs. Because we normally say your fair value consideration plus NCI less the net assets at acquisition, and you get your goodwill.
Yes.
So meaning that if you have already gone beyond the boundary, you have bought shares and gone beyond 50%. Afterwards, you don't need to start calculating goodwill. That initial goodwill that was computed, that is enough. So any changes you make after you are already a parent company, that does not count. But for these two, the first two scenarios, as long as you are getting into the boundary, you have to calculate goodwill. But goodwill will be calculated in a very easy way. How? You first recognize whatever acquisition that you had made, then you recognize at your current level where you have more than 50% shares. So all the things you were doing at first, you did recognize them. You get me? Okay. I guess you get me.
Mm-hmm. Yeah, just freezing.
Yeah, no, it's understood.
Yeah, today.
Mm-hmm. So, this is where we're saying the first two transactions are treated in the same way, but the third is not. There's a reason for this. Under the revised IFRS 3, a business combination occurs only when one entity obtains control of another, which is generally when 50% or more has been acquired. Before that, you don't look at business combinations because you are not even going to calculate goodwill anyway. So when this happens, the original investment, whether an investment in equity instruments with no significant difference or an associate, is treated as if it were disposed of at fair value and reacquired at fair value. This is where I was explaining to you that you de-recognize and then you recognize. So you de-recognize, meaning you are disposing of at fair value and reacquiring at fair value. Very interesting.
Yeah.
So if the 50% boundary is not crossed, I did mention to you that you do not need to calculate goodwill. The treatment, as when interest is in a subsidiary is increased, the dividend is treated as a transaction between two owners, common. So whenever you cross the 50% boundary, your value and a gain or loss is reported in profit or loss for the year. If you do not cross the 50% boundary, no gain or loss is reported. Instead, there's an adjustment to the parent's equity because you still have 50%. But when you cross the boundary, you go more 49 something, then you need to revalue and calculate a gain or a loss.
Or a loss.
So this is what Deloitte did. The Deloitte guide. If you're coming from 10%, which is passive, this is where you have equity investment and guided or managed or scoped under IFRS 9. You move directly or you make all these movements, you go into 10, you go under IFRS 10, which then now you become a subsidiary. Or you're moving from passive, you go into significant influence or a joint control, and you move into the boundary, crossing the boundary, you go to 50, then you go under IFRS 10 because then you can calculate goodwill. So acquisition of a controlling interest in an associate or a jointly controlled entity, that's what happens in there. So these are transactions that trigger remeasurements of an existing interest. So where an interest in subsidiary is increased from say 60 to 80%, it does not involve crossing. So as likewise, you don't need to calculate goodwill. I had already mentioned this. This is my exam emphasis. If you come across a question with a business combination achieved in stages, always ignore all purchases made before control is achieved. This is if the purchases bring the total holding to less than 50%. So just ignore. Just a glass of water. Okay. Are you there?
Yes, sir.
So let's start with the no control to control, where you're actually moving from a base of 0. Maybe you have 19%, 18%, 30%, then you're going to control. So we are saying no control to control. This is the first scenario. The accounting treatment is to treat the original investment as being disposed of at fair value and reacquired at fair value. So we redispose that investment that was made during, before control, you dispose it, but you reintroduce it at fair value. It's basically recognizing. So at fair value and reacquired at fair value. The fair value on the reacquisition plus the extra consideration paid for the additional new shares both become the cost of the increased investment. Let me give this example. You can memory peg with it. The example I'm going to give this is a very stupid example, trust me. Someone decides to find this good guy and they are staying as husband and wife. They haven't married each other. They have just started cohabiting and eventually they have children. But maybe this guy was even charged some 5 years ago, maybe 4,000 kwacha or whatever for the damage, for whatever it is. In an African scenario, these things happen a lot in volunteers, you don't know. And stays. But later on, they live together for more than 5 years and they decide to formalize the whole issue, to have this white wedding, to marry now nicely. And guy decides to put an additional 3,000 and gives it to that family so that now it's fully recognized. How much will be the fair value? How much will be the fair value for consideration? The cash.
It's 5,000.
It will be 3 plus 4,000. It will be 7,000. But what is going to happen? Even the family members, They will first recognize your relationship that you had and recognize it. They recognize it, dispose it at fair value because there was no whatever, and recognize it at fair value.
At 7,000.
So when you look at this is the same thing. You are saying this company maybe spent 5,000 with the shares that it bought, maybe it was 20, 30,000 shares or whatever. And at that stage, this company only had 40%. Let me put it into context so that it becomes much easier for you to understand. So before there was no control, this spent, company A spent 5,000. And they are the only 40%, 40% interest shareholding. Then now goes into control, additional amount, puts in 2,000 kwacha. And now it takes the control to maybe 61%. So the first thing that they'll do, they'll recognize, dispose of the first arrangement of 5,000 at fair value. Then later on, introduce it again, this 5,000 at fair value again, plus the additional 2,000. If there's NCI, they'll put in NCI there. Whatever amount of the NCI that you have, less the net assets at acquisition. So there's the net assets at acquisition. Whatever they'll get, that will be the goodwill. You have heard?
Yes, sir. So here, this is what we are saying. One, remeasure original investment to fair value and gain to profit or loss. And gain will go to profit or loss. Calculate goodwill. So the cost of additional investment, the fair value of existing interest. If there's any gain or loss, it will go to where? To profit or loss and gain. So then you have your NCI at acquisition, less fair value of net assets at acquisition and get a goodwill. You see the logic? Yes, sir.
So I want you to do this question fast. I'm giving you just 5 minutes. Then we'll do it together. Don't worry.
Just bring it a bit down and just see the formula, what is on top there.
Thanks, Mama.
Hmm?
Thanks. Hey, don't practice. This for get Hashima.
Go and get in your chair. Hello?
Are you done?
Yes. Hello?
Hello?
Network today. You're sounding as if you're very far.
This network thing, I don't know what is happening, huh?
I don't know if it's here or it's there.
So your phone good you of how much?
80.
80.
Sit and eat. Sit.
Let's do it
Sit.
together.
I'm in class, okay?
Let's do it together. And just share. So let's start with the cost of additional investment. Of additional investment, which is how much? Say we acquired 38% of the equity interest of Kavinda for 48 million several years ago. On the 1st January 2017, say we acquired an additional 35% for 58 million, 54 million. So we go back there, we put
54 million. 54.
Right?
Yes.
Then now we'll go to fair value of existing interest.
Enjoying.
I don't know what is happening.
What?
It's very frustrating.
Mm-hmm.
Has been even deleted. But then just to do this, you remember that's 54 million? This was for the existing, is it?
For the addition.
For the addition, huh? Then you have the existing, which was how much?
Which is 46.
Which is 46. Get it now how much?
100.
100. So 100, you bring in the NCI. Just check how much the NCI was. And the fair value of the identifiable net assets, blah, blah, blah. The fair value of non-controlling interest on 1st January 2017 was 27 million. The fair value of the original 40% holding was there 3 million. Okay, so here we have so this was just there for the original 40%, blah, 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 blah. But what we're interested in is the fair value of the non-controlling interest on 1st January, which is 27 million, right? Taking you to 127, isn't it?
Yeah.
So 127, then less what? Less
The fair value
yeah,
of the net asset.
of 100. So giving you goodwill of 27.
27.
80.
Also for NCI, you don't consider the addition.
No, before that,
Oh.
no, there was no NCI. Before that, it was an associate.
Yeah.
So do this question. Let me just dictate the question to you. Anyway. Jeremy acquired 40% of the equity. Are you writing?
Just a minute. Me, I'm busy. I'm in class. Okay.
Jeremy acquired 40% of the equity interest of David.
Okay.
Of David for 40 million. For 40 million kwacha several years ago. Full stop. On the 1st January 2015, on 1st January 2015, comma, comma, Jeremy acquired an additional 35%. Jeremy acquired
Additional
35% for 45 million. For 45 million. 45 million when the fair value of the identifiable net assets. When the fair value of the identifiable net assets were 105 million. 105 million.
105
million.
Okay.
First off, the fair value of the non-controlling interest on 1st January 2015. On 1st January 2015 was 13 million kwacha. The fair value of the non-controlling interest on 1st January 2015 was 32 million kwacha. The fair value of the original 40% holding
of the original
40% holding was 52 million. Full stop.
52 million.
Yes. Calculate the goodwill. Calculate the goodwill to appear in the Jeremy group. Calculate the goodwill to appear in the Jeremy group statement of financial position. Statement of financial position as at 31st December. As at December 2015, full stop. Giving you 5 minutes or under that. Are you done? Hello?
Just a minute.
How much is the existing?
40.
Taking you to 95, isn't it? To
85.
85. How much is the
Mhm.
NCI? It's 32.
Oh, 2016.
So 32 plus 85, how much you get?
$117.
How much is the net assets at acquisition?
105.
Fair value of the non-controlling interest was HU. Fair value of the original. The fair value of the original 40% holding. So actually here we made a mistake.
You acquired 40%.
Yeah, 40%, but you don't bring in the 40. I think even for the last example, it was wrong. This is the value at the time of acquisition. You need to revalue it at
It was already an associate.
the 2, yes. So this cancels, even there, you should cancel it. You should have the one that was after evaluation. I know I made a mistake. I showed 40% on top to 38%. So here, this is 52. So it is 52 plus 45, giving you 97, isn't it?
52 plus 47.
Or plus 45, it gives you 97.
Or the equity should be 52.
Yeah, it should be 52 because you have revalued it.
Oh, okay.
You have revalued it. Even this side, we should have put 53, not 46. It should have been 53 here. Because you are revalued.
53, no.
So it should have been 54 plus 53, giving you 107. Then this one should have given you 107 plus 27. It should have taken you to, it should be 134. 134 minus 100, it should have taken you to 134 minus 100, it should have taken you to 34 goodwill.
34.
So even this is 52 plus 45 plus,
Which is 97.
which is 97 plus 32, which is, this one is the NCI, remember?
129.
120.
129.
So 129 minus the NC minus the net assets. How much was the net assets?
24.
So
It was 105.
so it gives you 24 as goodwill.
24.
As goodwill. There were any problems. So that is how you get that. Hello, Yvonne.
Yeah, I'm getting.
Is not,
I'm there.
so you go and redo those questions. I think you have seen. I'll send, once the internet stabilizes, I'll send these notes on the website. I think in the next one.
Okay.
But you'll go through.
Okay.
So that tomorrow we can start on the another on the other scenario. Thank you.
Okay. Okay.
And
Okay. Okay. Thank you, sir.